Markets are sending signals that simply don't belong together. Gold and silver are at all-time highs. Stocks are also at all-time highs. The VIX, a measure of fear, is at one of its lowest levels in years. Meanwhile, consumer confidence is collapsing. These signals are not just contradictory, they are mutually exclusive. In a functioning financial system, they cannot all be true at the same time, and yet here we are. Safe havens and risk assets rising together. Gold and silver rise when investors are worried about inflation, debt, currency debasement, or systemic risk. Stocks rise when investors are confident about growth, earnings, and stability. When both are surging together, it doesn't mean everything is strong. It means money is fleeing uncertainty, not chasing opportunity. Investors are buying protection and risk simultaneously because they don't trust the system, but they also don't want to miss the last leg of the rally. That is not confidence. That is confusion. Record stocks, lowest fear. The VIX sitting near historic lows should imply calm, predictability, and stability. But nothing about today's environment fits that description. Rates are high, debt levels are extreme, geopolitics are tense. Growth is uneven. Liquidity is fragile. Low volatility here is not reassurance, it's suppression. It suggests complacency, positioning, and structural selling of risk protection. These periods rarely last. When volatility returns, it usually does so violently. The consumer is tapping out. While markets celebrate, consumers are pulling back. Confidence is falling, credit stress is rising, and discretionary spending is under pressure. This disconnect matters. Markets can ignore consumers for a while, but they can't ignore them forever. At some point, weak confidence shows up in earnings, margins, and growth expectations. That's when narratives break. A market built on contradictions. What we are seeing is not strength, it's imbalance. Assets priced for perfection. Fear priced for zero. Safe havens screaming caution. Consumers signaling distress. These are classic late-cycle conditions. They don't tell you when something breaks, only that the system is unstable. Something has to give. Either growth re-accelerates and justifies prices, or volatility returns, valuations reset, and confidence catches up with reality. History suggests the second outcome is more common. Markets can remain irrational longer than expected, but contradictions don't resolve gently. They resolve through repricing. When everything is sending opposite signals, the calm is usually temporary. And when it breaks fast.